Andy here. Welcome to Intermediate Corporate Finance Lecture 3, Week 3 portion of my lecture. This is going to be a lecture about risk-free rate in the capital market. And I hope you are staying healthy these days, right? I hope all your family members are doing okay. And some of you many of you may feel like, I wish to go out and then, have some fun, meet some friends, and then enjoy the facilities or somehow, right? Going to 노래방 or club and do something. No, okay? Young blood, I know, okay? I've been there before, right? When you're age, right? But this is the time we have to be patient, right? All of us have to be patient. I'm more thankful for our school, SKKU, right now, okay? Because some universities, they don't have internet lecturing facilities, so that they may have to do the lectures face to face later on in a couple of weeks, right? For me, okay. I previously suffered from tuberculostic pleurisy before, and I also suffered from pneumonia before, and 천식 as well. Like I don't know how to say it in English, but the 3 different kinds of lung related disease in my young days, right? When I was young. So I'm extra cautious about this pandemic, right? And thank God, SKKU has this video lecturing facilities, and the servers are performing well. So, I'm very grateful for this kind of environment right now in our technical support and all these things. Anyway, risk-free rate, that's going to be something we're going to talk about. Let's see, having said something about the virus, let's see how the market is doing, right? Here, what I show you is S&P 500 index chart. Let's see over here. What is this? This is the 500 biggest corporations traded in the United States, right? Their average stock price movement. You can interpret it that way, okay? So it's an index about their average movement. It shows their market cap in that sense, right? Now, what you see on the horizontal axis, okay, is the 15 minutes price movement, day by day by day by day, right? And what you see is that intraday movement is not that much dramatic. This is the beginning of the day. This is the end of trading day, the end of the day price. And so beginning to the end, beginning to the end, beginning to the end, okay, I should have drawn this, right, is not that much dramatic compared to what happens in the beginning of the day compared to the prior day's ending price. You see this movement and that movement, right? And then number 2, I'm not going to ask you this kind of things in the final exam, so don't worry, okay? Don't try to memorize it, right? Just to have a sense of what the stock market looks like as this kind of epidemic or pandemic spreads out throughout the world, okay? And here, what you see is S&P 500 index plunged by 6.24%. From here to there. It's always the index return. They calculate this return based on the prior day's ending price and then whatever the current minutes stock price, okay? Compared to the finishing price of yesterday, what it is like this moment, okay? I give you this interval over here. Okay, so how big is that? Okay, 6.24%. Isn't it natural? Okay, is it usual range of movement? Some of you may question. let's keep that question in mind. The next day, okay, March 13th, from the beginning to the end, okay. Oh, okay, let me erase it a little bit using different colors, right? Finishing price to the finishing price of the next day, right? That movement was 9.3%. Now, how can we put this into the perspective, right? Well, historically, average or standard deviation, I should say, standard deviation of daily stock index return. Standard deviation of S&P 500 index return, okay, is about, used to be about 1.5%, okay? So what does that mean? 9.29% movement is like what? Well, 1.5 times 6 is about what? 9%. So I say this is more than 6 standard deviation away from the mean. Okay? Or 6 standard deviation magnitude of upward movement, which is crazy, okay? If you look at this number only, okay, then you may say, wow, that's a great news. If I bought my stock at this moment, and then in the beginning of the market, and then held it until the finishing of the market, I must have earned on average 9%, okay, in a day. And if I keep on doing that for 360 days or 255 trading days in a year, right? Wow, I must have earned a lot of money. So shall I jump into the stock market like this kind of situation? I say no. Okay, I say no. Watch out. This is very, very turbulent market. No time to go in as an individual investor, right? No time. Here's the reason why. Okay, if you look at what happened in the prior trading days, right? The index level price plunged by about 10% or more. 10% or more. Okay, can you imagine that, losing your wealth, 10% of your wealth in a single day? That's been happening, and then there's bouncing back a little bit. Okay, and some of the individual investors may have thought, oh, if this thing keeps on happening in the next day and the next day, we may be recovering the prior stock index level. But I say no. Okay, I say no. Okay, we'll see reason why. By the way, let's see this color. Okay, I want you to familiarize yourself with this kind of finance.google.com or finance.yahoo.com or the websites, right? Financial market websites give you some index or price information and return information day by day or minute by minute, and you will see some color coding going on over here. You see it is in green color, okay? Green color means something good or up. green light를 비춰줘 kind of things, right? Green light. Something good from the perspective of investors, right? You earn money or make money. If you go back, right? If you go back over prior slide, where is that? Yeah, red color means bad. So price plunged. Okay, red color, alert, blood. You shed blood. Okay, so that's bad. In America, in Europe, and in Japan. Okay, how about in China? It's the opposite. Red means something lucky and good. Okay, I don't know why, but they just keep on having it. Red, 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 all red colors over there. Okay, so in Chinese stock market, they show gains in red colors and then loss in blue color or something. Korean market as well. We are following Chinese kind of tradition in that sense. So gain is shown with red color and then loss is shown in blue color. So some investors may get confused and trade the opposite direction and lose money. Watch out. Anyway, so color coding, you have to know about this at least as you take my lecture of intermediate corporate finance. You should be able to explain finance things to your family later on, right? A little bit, even though you are not majoring in finance, right? Anyway, so that's that. Now let's see. Yeah, what I wanted to show you, okay? What I wanted to show you, right? So 9% gain was happening, but 9.29% gain. If we look at the big picture movement of stock price, it looks like this. And then let's see, over the time horizon since 1980s, right? S&P 500 index has been going up and up and up and up, sometimes down, up and up and up and up, sometimes down, up and up and up and up and up and up. So this price going up, we say this is a bull market, right? Ooh, like a trying to push up, okay? 황소장, okay? Or boom time, bull market. And then the situation where we see this index level going down like this, okay? This period, we call that bear market. Right? Bear stretches you from top to bottom, right? Bull pushes from bottom to top, okay? Bull and bear, where do they go? Okay, how does that fighting end up? Okay, is always something interesting for finance guys. Anyway, so many people wonder if we are facing another bear market, okay? And formally they define it that bear market is the situation where the stock index like S&P 500 goes below 20% of what it used to be, okay? More than 20%. More than 20% plunging, okay? Not 20% up, that's bull, right? But 20% down from what it used to be, that's something called bear market. And of course, this is a bear market, that is a bear market, okay? The first one was the bursting of tech bubble, internet.com bubble. Second one was subprime mortgage crisis. And the third one, we are having it right now, okay? Is it a bear market? Can't you see it, man? Yeah. So that's something I have to tell you. Even though the index level went up by 9% or 9.3% a couple of days ago, it never means that this is, you know, not a bear market or anything, okay? You can just intuitively see that this is a bear market. And lo and behold, the next day, I have to use this, right, the next day, the price plunged back again. That's last night, okay? By how much? 12 percentage point down. Holy cow. How much of a magnitude is it? I think this is like a historically number 2 or number 3 biggest crash in a single day, okay, over the last, I don't know, 70 years or something, okay. The biggest crash happened in 1987. 1987, when was that? Over there, okay. You see a little bit of a blip over there, 20% down within one day, happened on Black Friday or something, okay, 1987 October, okay. Today we are having another one like that, okay. We had another one in the US market at least, okay. Very, very dangerous market. no time to go there, okay? Don't go there, especially don't invest with leveraged position or borrowed money, okay? Only with your own money, maybe you can trade it, but usually no, please. I know you are young, and when you are young, you are less risk averse, more courageous, more overconfident, 근자감이 쩔어요 kind of things, right? So that you jump in and then naturally you want to take some risk. But you have to stop that instinct, I think, right now, okay? And number two, why is this kind of stock price crash happening? Okay, crash happening. Well, of course, because we have the coronavirus going on in the whole around the world, right? Not just China, not just Korea, not just in the United States, but all around the world, right? Virus doesn't distinguish between nationalities. Oh, you are Korean, so we are not going to attack you. No, okay. To them, we all look like their houses, right? So they are just attacking us, right, all around. And pretty much all those cash flows are gone, right? The values, yeah, that comes from expected future cash flow, right? Remember this? I'm going to write this thing until you get sick and tired of it, and until it becomes your second nature. Value, true value, is your expected future cash flow. Discount that your relevant cost of capital. Can't you? Uh-oh, the lighting is a problem. Okay, so let me adjust the lighting a little bit. Okay. Right. So how's that? Okay, is it any better? Or this, right? Yeah. All right. So, true value, okay, is nothing but the discount of expected future cash flow. That discount rate we're going to study today. And cash flow, okay, the coronavirus drastically reduces your expected future cash flow a lot more down, right? And your discount rate is a function of risk, okay? The more spooky or the scary, then the discount rate will be bigger, higher, right? So the discount rate goes up, cash flow goes down. What happens to the true value of your company or any stock? It will go down naturally, okay? What's the problem, but can we observe this true value? The answer is yes or no. This is a refresher for last week's class. Can you observe true value of your company? Let's say 대한항공 or Korean Air or Lufthansa, right? Can you observe the true value of these guys? The answer is no, no, no. I told you before, you cannot observe the true value of this company, right? You cannot observe it. The only thing you can observe is a price in the market, price. You can see it. I told you before, I'm going to draw this kind of picture time and time again until you get sick and tired of it and it becomes your second nature, right? You can observe the price of it, but the true value we don't know. The trouble with this one is that it may or may not reflect the true value. Okay, is it equal to true value? We don't know. Okay, at least we can see that in the past maybe the value was high enough, but now we have to adjust the true value and the price has to follow that. That's why we have this kind of crash happening. And then we are largely groping in the dark, estimating the true value in their own way. All these investors are fighting and buying and selling and then arguing, oh, this is a true value, that is not a true value. And then they keep on fighting in the form of trading. That's why we see a lot of volatilities going on in the stock price, right? And then the trading volume is like crazily high. Some of my friends asked me, okay, is it a good time to buy a stock? Especially because we have this 9% up or 5% up every now and then these days. My answer is no. Don't go there because we don't know. Not you, but we as a whole. Usually the individual investors, right? The individual investors. We call them 개미, right? Individual investors. In Korean terminology, this is Korea, so I teach you one Korean terminology, right? 개미, right? Individual investors, okay? They are less informed, which means we don't have information, and then we don't have good information processing capacity, which means we are not smart, okay? Let's admit, no matter how good you did in your college entrance exam or IQ test or what the hell ever, we are not good at it, okay? No information, and even if you have information, the processing capacity in your brain, our brain, is not good. Compared to whom? Institutional investors. Let's say in Korean terminology, it's 기관 투자자 or institutional investors. Okay? Institutional investors like hedge funds or mutual funds or banks, right? Brokerage houses, they are dedicated. They're professional investors, right? And they have great computer machines to support their work, right? And they have the best, perhaps the best, and usually always the best information network. It has been there ever since the human history, right? 19th century Rothschild family, their information network was much better than any other kingdom's information network, okay? Similar things, right? Bloomberg, you know about this. Information network is related to finance. Reuters, all that kind of, information network. It's all related to finance. Those institutional investors are much better informed than you are, okay? Typically what we find these days is just institutional investors sell and individual investors buy. Then which one do we have to follow? Follow the institutional investors. So don't buy it at least, okay? Sell it together maybe, but you don't have a stock. Don't do anything, okay? Don't go there. That's the best solution as an individual investor these days. I have to be clear about this. And some of you may wonder, oh, the foreign investors, right? In Korea, we have three parties in trading. 외국인 or foreign investors, okay? And in journals, news media, these foreign investors are labeled or painted as evil, greedy foreign investors, whereas institutional investors are always doing good for something good for Korean people. But what's the reality? After all, these two guys are institutional investors anyway. Okay, they are hedge funds, either Korean or foreign, and their behavior is completely rational. Usually, I would say, rational, very rational, cold-blooded, the same guys, okay? Just the news media want to paint those foreigners in tough times so that these domestic individual investors have some place to blame. Okay? Instead of blaming these domestic institutions, blame foreigners, they would say. But that's not fair, I say. They're all the same institutional investors. So don't follow individual investors like ants or camis, right? Over here. Cami means ants in English, right? So that's something I have to tell you. Having said that, let's look at this picture. Okay. Yeah. This is a picture telling about depicting the situation of Korean stock market these days. The original picture comes from 500 years ago when Japan invaded Korea, and then This is a Busan castle that is invaded by the Japanese armies and navies before. And then what you see over here is the corona factors coming from all different countries, right? And then what the individual investors over here try to protect is what? Samsung, what is that? Samsung Castle, right? The value of Samsung will be still there. The individual investors, they try to buy Samsung stock so much. Take this as an opportunity to buy Samsung cheaply, okay? But I would not go there. I would not go there, right? Follow whatever the institutional investors and foreigners are doing. Don't be poor ants, right? Here I show you three kind of hedge fund managers who are representative of those institutional investors. Warren Buffett and Jim Rogers, and then George Soros, Quantum Fund, right? Now, what did they say last year? December and November time. And I show you the news article coverage about these guys. Where are they? Excuse me. Yes. Jim Rogers. Last year, December 1st, news article says, he said, next year, we're going to have a huge economic crisis all around the world. So I'm going to buy gold and crops, the farm, right, products, foods, all these things will be a problem over there. Okay. He did not know, or he did not say specifically what will attack the world, but we are having this crash. Okay. Lo and behold. And how about the second one or the third one? George Soros, right? Last year, again, end of last year, or beginning this year, 2020, January 25th, he was saying that the US economy was overheated, it's in a bubble, so there will be a crash. Okay, we are experiencing one right now. And then another one that I tried to show was this Warren Buffett. Okay, Warren Buffett. Some kind of technical glitches over here. Let's see if it works better. Yeah, Google Chrome works better than Microsoft. Okay, that's what we find, by the way. Anyway, $128 billion and growing. Warren Buffett's Berkshire Hathaway have cash puzzle. Okay, what does this mean? What does this mean? We're going to learn about this kind of idea throughout this semester. Okay, DCF valuation guy. Okay, Warren Buffett is a most typical or representative guys in using intrinsic valuation or DCF valuation methodologies. And based on this, Berkshire Hathaway decided that so many things are overvalued. Now we're going to cash out everything. Okay, nothing to hold because nothing is undervalued at this moment. Okay, nothing is undervalued or so small number of stocks that are undervalued, so we don't take positions usually. Okay, cash it out. Now we have a lot of cash balance in Berkshire Hathaway. When was that? November 4th. Okay, a couple of months ago, or 5 months ago, should I say? So these kind of institutional investors have much better information processing capability than individual investors. So if you want to play in stock market, follow these guys. Okay. Chase these guys instead of trying to chase the other individual investors. Now, of course, the individual investors that draws your attention, your brothers and sisters or your neighbors or uncles or friends, right? You may perceive them as very smart, exceptional individual investors. Oh, 압구정동 물고기 kind of guys. But no, not enough. Not enough. Okay? What I'm saying is these officially classified institutional investors, those guys' behavior you have to follow, but not individual investors. Okay? So that's that. The distinction between individual versus institutional investors, I'm going to ask you in the exams anyway. I told you in this lecture. So study this part yourself. Now, valuation, okay. Two most important channels of value, I told you, what are those? Cash flow and discount rate. It gets back to the time value of money, as I said before. And cash flow, we'll discuss later in the semester. Discount rate, it's about required rate of return, RRR, or discount rate, whichever way you want to say it, it doesn't matter. But this is what we're going to go through from this class, right? It's a function of risk of the cash flow and the risk-free rate, okay, risk-free rate. And then before we move on further, one thing I have to nail down is that cash flow and discount rate in our valuation, they have to match. Okay, matching principle? No, not like accounting, but there has to be some logical matching. Okay, the discount rate has to reflect the riskiness of cash flow of the company that you are analyzing. Okay, there has to be a match. Now, holding period return, we have to be clear about this because I found some guys who are not even being able to compute the returns correctly. The return, okay, of any stock investment looks like this, okay. Let me use a color coding here. Yes, the return. Well, what was your initial investment? What was, let's say you're purchasing Hyundai Motors, right? Hyundai Motors stock. Your initial purchase price would be there. That's P0, day zero purchase price, P0. And your investment return will be two things. So one coming from capital gains and the other coming from cash gains. Okay, cash gains. Cap gains, what is that? The stock itself, the securities price may increase or decrease. That end of the day price, I will call it PT. Okay, you see big PT, sub T. Okay, so the cap gain return will be this part. So end of the day or next day's price, right? Next day's end of the day price, okay? Or your selling price, okay? The moment you sell the security, right? End of the holding period. End of the holding period price minus the initial investment price, okay? Over initial investment price. That's your cap gains return. How about the other part? Cash gains part. Cash gains part is this one. As you hold the security, you may get some cash gains in the form of dividend in the usual stock investment setting, right? Some stocks pay dividends, some stocks don't pay dividends, okay? Dividend, what is that about? After doing all those sales and paying all those expenses, you are left with net income. Now it's time to either buy or like a share among share dividends among the shareholders, or either or, right? Or reinvest, right? So the dividend may come into the pocket of the shareholders. That's cash coming into your pocket. That is attributable to your initial investment. So dividend amounts that you got at the end of the day divided by your initial investment price. Okay, that's the return concept that we have. So the return that we talk about incorporates both cap gains and cash gains. Okay, now we move on to next slide. Yes, cash flows and discount rate has to match, right? The currency of the cash flow has to match. Okay, if you're valuing in US dollar terms, your discount rate has to be in US dollar terms as well, right? Nominal versus real. If you're valuing your company in nominal dollars, right? 명목 value, right? In Korean terminology, 명목 or nominal value, then your discount rate also has to be nominal rates. If you're valuing in real terms, real cash flow, then your discount rate also has to be real discount rates, net of inflation rate. Okay? And your discount rate has to match your cash flow in terms of investment horizon. This will get clearer as we discuss more about the risk-free rate. I say right now, if you are valuing a company over the next 1 year only and sell it off later on, then your investment horizon is just 1 year. Your risk-free rate has to be just 1 year risk-free rate. On the other hand, if your investment horizon is like 30 years down the road, then your benchmark risk-free rate also has to be 30 years risk-free rate. Okay, the term has to match. I will tell you more in detail about that. Equity versus firm has to be also matching. Okay, what are you talking about? Okay, well, it has to do with our valuation methodologies, right? There's a choice, okay? Choice between equity valuation versus firm valuation, even in DCF valuation, okay? What do you mean? Equity values and firm values, aren't they the same thing? Preview of equity valuation, right? This is the cash flow from assets after taxes and debt payment, and after making reinvestment needs for future growth. And discount rate should reflect only the cost of raising equity financing in the capital market as of today. Okay. Present value is a value just the equity claims on the firms. Okay. So that's equity valuation is more direct method of valuing the shares, stocks in the market. An example of equity value or cash flow is dividend. Okay, dividend discount model is perhaps the grandpa model of the valuation. Okay, thinking about 500 years ago when there was a East India Company, and then all those stocks traded in the London Stock Exchange or Netherlands Stock Exchange, Amsterdam, right? The way they valued the cash flow to these equity holders was dividend discount model. Okay, after doing all these trading for spices and teas, and right, what's the dividend that you can expect as shareholders, right? So that's the grandpa model. Now the next one, from valuation, the cash flow considered here are those from assets prior to any debt payments, but after firm has reinvested to create growth of the assets. Okay, so what's the difference between those two? Okay, whether you consider the payment to the debt holders or not. Okay, the cash flow to firm is essentially the cash available to both debt holders and equity holders, whereas equity valuation is about the cash available to equity holders only. Okay, in equity holders cash flow, we have to say bye-bye to two parties, which is government and debt holders. In firm valuation, you have to say bye-bye to only one party, which is the government. You don't want to piss off government. If you don't pay tax, right? You don't want to go to the IRS. 세무조사 한번 받아보시겠습니까? Crazy. Your business will be essentially screwed up. All stopped, right? Government, you have to pay taxes. First of all, say bye-bye. Remaining cash, of course, right? You have to think about the reinvestment, okay? Afterwards, these are the cash flows available to both debt holders and equity holders. That's why once we get the present value of firm cash flows, what we get will be the market value of total firm, which has to be divided into both debt and equity later on. Okay. Now, discount rate should reflect the cost of raising both debt and equity financing. Okay. As of today, the perspective always, right? Equity valuation, firm valuation, no matter what, the perspective is the cost of capital required as of today. Okay, why? Because you always have to be concerned about how to raise capital for my project today, if I go to the capital market today. So the cost of capital, whether it is equity or firm cost of capital, it has to be today's cost of capital, okay, in the market right now. The present value is the value of entire firm and reflects the value of all claims of the firm. The value of equity, therefore, is firm value minus what? Debt value, okay, market value of debt, okay? Here we are considering only the market value. Forget about book value, all right? This is not accounting class. Happy, all right? Good. Now, discounted cash flow valuation. It's time to talk about that discount rate first, okay? Here you see the discount rate. And once we finish the discussion of discount rate, which is going to happen in a couple of weeks later, then we'll move on to cash flows and growth, okay? Let's see, the cost of equity should be discussed first, and then we'll move on to cost of debt, because in the balance sheet, let's see, the balance sheet, you have debt and equity, right? Here's the asset, right? So cost of equity and the cost of debt. And then we'll move on to weighted average cost of capital, which is quite natural, right? Weighted average of these two. And before that, right, in the cost of equity, we'll have to think about risk-free rate, equity risk premium, and beta. So we're going to go through these things one by one. Why is that the case? Because if you think about your capital asset pricing model formula, right? What was it? Well, that was RF plus beta of your stock, RM minus RF. Do you remember this formula? First time seeing it? You're in trouble, man. Refresh your memory, okay? So we're going to go through item by item, one after another, right?